Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with stocks inching higher after getting a boost from better-than-expected Google earnings. After the closing bell today, we'll hear from Meta and Microsoft. Katrina Dudley of Franklin Templeton writing, "People are worried, cautious and generally bearish. We disagree. Tech company earnings continue to be strong." Katrina joins us now for more. Katrina, good morning.
Great, good morning.
Hard to be bearish with alphabet numbers like the ones we saw after the closing bell. Are you looking for more of the same?
You know what, I actually wrote that statement before the alphabet earnings came out. And I have a look, if you look at some of the earnings that are coming out of these technology stocks, it's really positive. And don't forget, it's positive surprises on top of earnings growth, which is very different versus like a positive surprise when you're expecting earnings to go down and they go down less. So I think it is actually very positive. But we are worried because everyone's bearish. The soft landing is kind of like, well, that's fine. And I think that we are just generally more optimistic.
Are you worried, or does it give you confidence that you're actually on the right track? If everybody is bearish, does that mean that actually there's more upside for you?
I think that there is a lot of upside in the market, and some of the indicators that we're looking at is look at the productivity data. The productivity number was 2.5%, and we haven't seen that type of growth for a long period of time in terms of positive productivity. The bearish people are pointing out to the fact that it's immigration. We're not counting the immigration numbers. We're not doing that correctly, and they're driving all of that productivity. We take a slightly different bent. We actually think this is one of the outcomes of some of the supply chain shortages and some of the reduction in the labor and tightness in that labor market. People are actually doing more with less, and that is productivity.
People. Is this the tech companies, or is this everyone? And I'm talking at a time when some of the earnings, particularly with auto manufacturers as well as certain consumer-facing companies, have been, not great. They're not the same kind of blowout results that we're seeing from the likes of Google.
And I don't like talking about this, but if you take a look at the low-end consumer, that is where you're seeing a lot of this weakness show up. So you look at the McDonald's numbers and you look, obviously we had the E. coli issue, but you combine that with the negative foot traffic. We are seeing the low-end consumer under some degree of stress. And I think what that's going to actually show up is potentially more in the election versus actually showing up in the stock market, because even though there's a lot of people in the low-end consumer, it's not a big driver of spending. And so even though they are starting to see pressure, I'm not necessarily sure that they're actually going to derail the economy.
So this raises a question. If you do see this overarching momentum, and that could lead to higher yields, because essentially it could mean that a growth economy is really on the table for next year, at what point does that create some sort of downside to valuations for equities? Or do you just ignore it and say, stop being so bearish, bond market?
I think, first of all, we think in terms of valuation, the market's probably on a multiple basis is reasonably fairly valued. What people are getting wrong is the earnings growth number. And so the fact is that even if you just hold that multiple flat, if we continue to deliver better than expected earnings, the market can work because we'll still have that growth in actual underlying economy. So that's what we think the market is missing. They're so focused on the valuation level. We think that higher valuation is a reflection of some of the benefits of the network effect, which is driving some degree of concentration in the market, which is positive.
Is politics playing at all in your bullish view?
So let's go to politics. We're in the countdown, and I think it's an interesting thing. I think the non-consensus view is actually coming. If we look at some of the quant data that's coming out, there's approximately a 60% chance that we have one of these candidates with over 300 electoral votes, which would be a landslide victory. The problem is it's too close to call which of the candidates is going to be that way. I know you've seen some of the betting data, which is favorable to one candidate over the other. We're not necessarily trusting that data. I think, though, a landslide victory would be really good for the stock market and the economy, and therefore it actually, in terms of the November 7th Fed decision, I think that will also weigh in.
A landslide victory for who? A red sweep or a blue sweep?
That's the unknown. Unfortunately, I think that we will have a sweep, and I think that we'll have a fairly definitive outcome. Unfortunately, it could swing either way, which, however, I think you need to stand back and look at the fact we're going to this election with so much uncertainty that just having the fact that the entire country coalesced around one candidate will be very positive in terms of bringing the country back together.
And you think that'll be positive regardless for the stock markets, even though they have, in some regards, very different policies?
Yes. So what does that mean? If we have a Trump victory, obviously we need to start looking at the language that he's put out there regarding tariffs. The bearish expectation is you take him at his word, and that would be very negative in terms of the tariff levels that he's talking, the 10% and then the higher levels of tariffs on China. I think he's a negotiator. So we're probably in the camp. I think it is also within consensus, the fact that he's actually just positioning and that he won't go that far in terms of what his language. So I think that in terms of outcome is going to be more positive. We don't see that negative downside scenario. Going to Kamala's policy, we go back, do you want to start looking at some of those names which have been disproportionately and negatively impacted by exposure to the low-end consumer? You're looking at McDonald's. You may want to start looking at some of those regional gaming companies as well. So there's definitely some beneficiaries. I think you just need to look for those beneficiaries in some unusual places.
If we're talking about a sweep, though, we're talking about the difference between a 15% conditional corporate tax rate or one going up to 28%, aren't we?
I don't necessarily think 50. He likes round numbers. Okay, so we're at 21%. But when he first talked about it, we were at 35. So the difference of going to 35 to 21 is significant. I think if he goes anywhere, it's 20 to 21 down to 20. As I said, he's a round numbers person.
What about 21 to 28 on the Harris side blue sweep scenario?
It will be a headwind to corporate earnings. I think that you cannot underestimate that. But offsetting that is her position on tariffs isn't quite as extreme. And then you have some of this support for the low-end consumer. She's talking in terms of some of the transfer payment metrics. The concern that we have, does the corporate tax rate increase come in fast enough to offset any of the increase in the fiscal deficit driven by her
You're looking forward to seeing the back of all of this next week?
I'm actually enjoying it. I think it's interesting because this is what drives markets, and this is what makes our job so interesting. But you're right. If I come back, in a week's time, we're going to be talking about something else. We will be talking about 2025, actually.
I hope we are. I really do, and I hope we're still not sitting here trying to figure out who actually won the election. Equity futures on the S&P up by 0.1%. Katrina, it's good to see you. Thank you.
Great.
As always, Katrina Dudley there of Franklin Templeton. So here's the latest. As many investors lean into Trump trades, some warnings begin to build. Citi suggesting it might be time to take profits. Dirk Willer writing, despite investors concluding that Trump would be the victor, the polling bias is only moderately in his favor. We therefore take profits in some of our Trump-biased election trades. Dirk joins us now for more. Dirk, welcome to the program, sir. Let's get into those trades first of all. Which ones would you take off at the moment?
Thanks for having me on. I think there's a lot of consensus among investors that Trump has already won, right? And almost every pollster think, listen, it's really very close to call still, and therefore it's not really a foregone conclusion, even though the odds are slightly in his favor. So the trades we decided to take off are 1 hour long break-even trade. As you know, there's a lot of concern that a Trump administration would mean more inflation, or actually for several reasons, because of the immigration policies, because of the tariff policies, and because of fiscal expansion. And so the inflation market priced meaningfully higher pretty much across the curve. And we think that is really quite mature. And that could have a meaningful backlash if Trump still were to lose. And therefore, we think that is really one that we would take off. The other one is in the dollar. People really piled into the dollar. And of course, they piled into it for two reasons. One, because the macro changed. The NFP was very strong, and that changed the sentiment around the dollar. But the second thing was, of course, Trump. Again, tariffs being bullish Trump, fiscal policy being bullish dollars, fiscal policy being bullish dollars. And that is also quite a mature trade. And so we took off our euro downside structure.
Dirk, that's what makes it slightly more complex. we need to figure out what was driving the trades to begin with. Why do you believe this was more about Trump's prospects than just about fundamentals, the economic data, and monetary policy too?
It is true. It's almost impossible to figure that out fully, because even if you say, well, the dollar just moved with rates, rates moved with Trump, right? And so what is somewhat hard to say. But I would say the extent of dollar buying that we've seen was much more extreme than what you typically get if it's just an NFP print or if it's just a change in the economic outlook. It really was really quite large. You can also see where it happened. Investors bought most in dollar China. Dollar China is, of course, the single biggest Trump trade that there is. It's now a very big consensus trade. Now, I would say we have still a structure that would benefit from higher dollar China after an election. And we kept it. And the reason is that I think the PBOC is really a little bit an investor's friend in calming down the volatility, in making sure dollar China doesn't overshoot too quickly, too fast. And so I think investors are still able to add to dollar China for that reason. But in general, to answer your question, where this dollar buying happened is a clear indication that a lot of it had to do with Trump.
How many of your clients or your compatriots, Dirk, are curious about playing in the Trump Media and Technology Group in Bitcoin?
Yeah, I don't cover single equities. Bitcoin is, of course, also a Trump trade, and it's a little bit similar to gold. Gold also had a very strong move, of course. Now that gold is a Trump trade is really quite curious, because usually, and the same is true to some extent for Bitcoin, if rates go up and the dollar goes up, that's a terrible environment for gold. Now this time around, we have rates go up, dollar go up, and gold does great. And the reason is, of course, again, these inflationary fears with the Trump administration, and even more so, it's inflationary fears with the Fed not going to do much about it if there was a higher inflation. And the combination of higher inflation and a dovish Fed is, of course, a great environment for gold and also for Bitcoin.
Dirk,
so I think that explains a little bit the paradox.
Dirk, why do you think the financial markets are taking their cue from the betting markets and not polling?
I mean, I think what is happening is that markets love momentum. Right, and the polls, they are, of course, have moved in favor of Trump. They have showed some momentum, and people just ride that forward, and they jump on the momentum train. And that is what we see in markets all the time, and that's, I think, how people use the polls. And it might be right. I mean, there is some momentum in polls, and that is what we're seeing. And, you know, at this stage, Trump, of course, has the upper hand, and I think that is clear both in polls and in betting markets. But the extent to which he has and the confidence we can have in the outcome, I think, is somewhat exaggerated in markets.
Hey, Dirk, appreciate your time. Thoughtful piece. Thank you, sir. Timely, too. Dirk Willer of Citi. Joining us now to discuss is Claudia Sahm of New Century Advisors, a good friend of this program. Claudia, welcome back to the show. Let's get into this economic data. How would you characterize the economy in America?
Good news is good news. I mean, this is excellent on the GDP, particularly when you look at the consumer spending. It's not just one quarter. We have now put together 4 quarters that are about 3% growth in consumer spending, inflation adjusted. And as Michael said, you put that together with business investment, right? Like, that's what we're looking for. Like, this is a really good report, and it's not one to be afraid of. The Fed is not going to be afraid of this report. We have supply coming online. We have productivity higher. Like, this really is good news.
Claudia, they might not be afraid of the report, but they could be potentially a little concerned about the response to the report in markets. At what point does it get the Fed's attention that longer-term yields keep climbing on the back of an ongoing string of better-than-expected economic data?
The Fed is going to be paying attention to what markets do, regardless of whether it's what they're expecting or what they're not expecting. It's hard to play three-dimensional chess with markets. There are a lot of factors that move markets. The Fed is an important player in the mix, but it's not the only. But it absolutely will be looking at interest rate sensitive sectors, places where it could go in. And if there needed to be some support, cut rates, get some support. But that's not what we're seeing right now. We're seeing a very strong economy. And what the Fed has to look for are any signs of it overheating. right? Is that consumer spending? Is that demand that's really outstripping supply? And at this point, we really do not see signs of it. And we haven't for several quarters, right? Like this, we are in a trend place that is much better than, frankly, we went into the pandemic with.
There are two different arguments here. One is this question of whether we're overheating and thus causing the Fed to stop cutting rates. And the other question is, are we underestimating the neutral rate that we could potentially be looking at in an economy that keeps chugging along, even with rates that the current Fed says are significantly restrictive? So which is it, Claudia? Because there are very different responses on the Fed side to either of those two potential outcomes.
At the end of the day, we want the neutral rate as high as absolutely possible because a high neutral rate is a sign of a healthy economy. The low interest rate economy that we went into the pandemic with, that was not a healthy economy. It created a lot of distortions, but it also was just a sign. Interest rates are a price. They are telling us something about the economy. And if it turns out that this economy comes out with higher productivity growth, higher underlying trend, well, we would expect that to show up with a higher interest rate, and it's an interest rate that we would tolerate. Like, it wouldn't be restrictive. It'd just be we have a stronger economy. Now, it is too soon to say that is what we have moved into. This still could be, working through some of the temporary disruptions of the pandemic, and we could go back to a lower trend growth. And I think Europe is very much a cautionary tale, right? They are not having this conversation of, have we gotten to this higher trend level? Is our star just so much higher? So there's still a lot in the mix, but again, where our star lands, I mean, that a high R star is perfectly fine, but we are in that process of discovery of is this good news going to stick with us?
Well, when you say good news is good news, does it marginally increase your best guess about where the neutral rate is? Do you think that it's more likely around 4 now than 3.5 as the Fed's projecting?
I don't know if I'd go quite as high as 4. I think, into the solid 3% is what this looks like. And particularly, again, if the implicit productivity growth that goes with this GDP number and a labor market that, while still solid, has slowed down quite a bit, right? So we are getting a lot out of the resources that we're putting into the economy. And so if that continues, then yes, I think something in the mid 3%, probably maybe even higher, would make sense. But that's where I think the Fed, they have their first 100 basis points, the next 100 basis points, I think are pretty safe in the, that's still restrictive, we can chip away at that. And then you do get into a conversation as you get past that of, okay, is this where the economy wants to rest?
Claudia,
and,
if we're going to live with higher interest rates, what does that mean for the housing market?
Again, a higher interest rate environment, when it's behind it is productivity growth, you also have higher income growth. Right. And so interest rates are a price, just like house prices are another price that people face. And what at the end of the day matters is the affordability. Right. Do you have the resources to afford those homes? Now, of course, the higher interest rates do run into the fact that we have had a housing underbuild for quite some time. And so if you think that if we're going to try and fix that underbuild just with market prices, so the adjustments of the interest rates, that one is going to be tricky. But I think there are certainly policy proposals on the table at various levels of government to try and work on housing supply and not think of it purely through interest rate mechanisms and what the Fed might be doing.
Right, but that could take years to come to fruition. So if you're sitting on a 3% mortgage and rates you say are going to be higher for longer, what impetus is there for those individuals to give that up?
There's not. I mean, that's what, there are always, if there are big shifts in the economy, there are going to be winners and losers in terms of where they sat on the bet, right, on the information when everything changed. So, that's just a reality of how the economy works. It does mean the housing market went into the pandemic in a place of disruption because of the housing underbuild, and then it has been throughout this entire period in different forms of disruption, whether it was really fast-paced demand, really low interest rates, whether it was no inventory of housing. So that is a extremely disrupted sector, not just because of interest rates. And I agree with you. There is no there's no magic wand in that market. It's going to take time, and it's an extremely important one to get right-sized.
One thing I know for sure is that was personal to Anne-Marie, Claudia. She just wants to buy a house. That's all it's about. Is that what that was about?
It feels like the boomers, or those that time the market correctly, Lisa,
I know.
are the winners, and then those that are younger trying to get in the housing market are the absolute losers.
Are we calling Bram a boomer?
No, I said those that, I know, I called her a winner for timing the market correctly.
I'm not sure Bram.
I bought in April of 2020, so I wasn't going to rub it in, but yes. And
Why
I'm
not?
a boomer.
Why not? And since we're being personal here, Claudia, can I just have one personal note, just quickly? We know you're in your own personal battle right now. And I just want to say on the behalf of all of us, and if I may, the whole financial community as well, because I've had a ton of messages just before you appeared with us. We're all thinking of you. We're all thinking of you, and we appreciate your time. We're lucky to have you this morning. Thank you so much for being with us. Claudia Sahm there of New Century Advisors.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.